Hello and welcome to TaxCast, the podcast dedicated to exploring Australian taxation issues. This show is specifically crafted for owners of small to medium-sized accounting firms serving the SME market. I'm your host, John Jeffries, and this podcast is brought to you by my business, John Jeffries Tax. Let's dive in. This is episode number 2, and it was recorded on the 26th of December 2024. As 2024 comes to a close, we've seen a wave of changes in tax and superannuation laws. Some of these changes may seem minor on the surface, but they have profound implications for how we serve clients and run our firms. Today, I'll walk you through the 9 most impactful changes, in my opinion, that affect the owners of small and medium accounting firms. I will count down from the 9th most impacting change to what I consider to be the most impacting change on you. Let's jump into our first topic. We begin with financial advice fees, which comes in at number 9 on my list. This year, the ITAA released a tax determination clarifying the deductibility of financial advice fees. Let's break this down. Non-deductible fees. Initial advice on proposed investments or on pre-existing investments when engaging a new advisor are non-deductible. These are considered to be capital in nature. Financial advice fees can also be of a private nature and non-deductible. An example is advice about the family budget. Deductible fees. What is deductible is regular ongoing advice fees related to income-producing investments. An important nuance here is the distinction between personal financial advice and tax-related advice. If the advice includes tax planning or involves tax implications, the portion attributable to tax-related services remains deductible. This determination reiterates long-standing positions, but it's a reminder for accountants to help clients clearly allocate and document financial advice expenses. Failure to do so could lead to missed opportunities for deductions or disputes with the ATO. At number 8, we have the Federal Court decision in Chung versus the Commissioner, which carries lessons in how gifts are classified for tax purposes. In this case, a $33 million transfer from a sister in Vanuatu to her brother in Australia was challenged by the ATO. They argued it was taxable income. The court, however, sided with the taxpayer, ruling it as a non-taxable family gift. Here are some insights for accountants. The court emphasised that gifts need clear evidence of intent and relationship if that is applicable. Documentation is critical. The judge criticised the ATO for proceeding without substantive evidence. This serves as a reminder that the burden of proof lies still with taxpayers, but nevertheless, the tax office just can't run flags up a pole. For clients with significant cross-border transactions, ensure they maintain clear records and consider the context of such transactions. When advising clients, always evaluate the risk of ATO scrutiny for large or unusual amounts. Coming in at number 7 is guidance released by the ATO on Section 99B, which addresses distributions mostly from non-residents. There are 2 documents, PCG 2024/3 and TD 2024/9. This is an area that requires accountants to roll up their sleeves and dive deep into record keeping. Now here's what you need to know. Distributions from non-residents to Australian beneficiaries will be taxed unless an exclusion applies. Exclusions apply to corpus amounts, pre-CGT assets, and certain non-taxable amounts. For accountants, the challenge lies in obtaining detailed records from overseas trusts. Often this means reconstructing trust transactions according to Australian tax principles, a daunting task when dealing with incomplete or foreign documentation. I'll have a bit more to say about these documents a little later in the podcast. Number 6 on our list is a cautionary tale about small business CGT concessions and valuations. The Maloney versus Commissioner case shed light on the complexities of the $6 million net asset value test. The issue here was differing valuations of a business during an internal restructure. While the taxpayer's valuation allowed them to claim concessions, the ATO's valuation, double the taxpayer's, would have disqualified them. Ultimately, the court sided with the taxpayer's revised valuation, but only after significant effort and legal expenses. Here's what this means for accountants. Always stress test valuations, especially when they determine CGT concession eligibility. Engage independent, reputable valuers and document all assumptions clearly. Be mindful that the $6 million threshold isn't indexed, meaning more clients may fail this test as asset values grow over time. For number 5, let's turn to a case that resonates with accountants serving long-haul truck drivers. I selected this case because accountants frequently have truck drivers as clients, but note that this applied to an employee driver. This was the case of Duncan versus the Commissioner. In this case, a truck driver claimed meal expenses based on a travel allowance. The tax office denied most of the claim because the taxpayer couldn't substantiate it. However, the taxpayer's accountant said the substantiation wasn't necessary because the driver's daily spend was less than the ATO's reasonable amount, and the driver received an allowance of around $40 per day when he was away from home. However, surprisingly, the AAT held that the allowance was not for food and drink. It concluded the allowance was for accommodation only. This meant that the driver did have to substantiate his expenditure. Here's what to take away. Ensure clients have clear records of the purpose of allowances. Misclassification can drastically reduce the deductions if substantiation is not available. While bank statements help the taxpayer recover some expenses, proper substantiation, like receipts, is always preferable if it is needed. The rules around travel allowances can be confusing, so take the time to educate your clients about qualifiers and what doesn't. Number 4 highlights a new ATO document on the issue of who qualifies as an employee for tax and superannuation purposes. This follows some significant High Court decisions. Gone is the multifactorial approach. Now, the terms of the written contract are paramount. If the contract comprehensively outlines the relationship, it governs the classification. The ruling that dealt with this issue in relation to superannuation guarantee has now been withdrawn. There is now one ruling on this topic that encompasses both PAYG withholding and superannuation guarantee, TR 2023/4. Number 3 involves payroll tax issues for medical practices. Different states have taken varied approaches to taxing payments to medical practitioners. The issue concerns the situation where the medical practitioner is considered to be a contractor and not an employee. Accountants should monitor state-specific announcements and ensure clients are informed of their obligations. At number 2, we delve into the ATO's draft guidelines on personal services income. This is PCG 2024/D2. This guideline threatens the application of anti-avoidance rules even when PSI conditions are met. The ATO makes it clear that, in its view, there is a potential for Part 4A to apply to any situation where 100% of the personal services income is not assessed to the individual that earned the income. This could significantly impact small businesses, particularly those structured to split income among family members. If finalised in the current form, the guidelines may require clients to restructure their operations and request amended assessments. This is a very serious development that affects many accountants. In my view, the PCG proceeds on a technical flaw. It will be interesting to see the form in which the PCG is finalised. Finally, the number one change that I consider will affect nearly all tax agents and BAS agents is the amendments to the Tax Agent Services Act. Its new provisions, including Dobbin rules and stricter ethic requirements, will reshape how tax agents operate. In my view, the biggest challenge will be for small and medium-sized accounting firms to have in place by 1 July 2025 a system of quality management that is designed to give you reasonable confidence that you are complying with the Code of Professional Conduct. As we approach 2025, there's much to anticipate. A federal election could bring significant tax policy changes. We will also watch for the full federal court decision in the Bendel case, which will examine the question of whether an unpaid present entitlement to a private company is a loan for Division 7A purposes. In the next segment of this podcast, I discuss two ATO documents recently released that related to Division 7A. The ATO has recently released two significant documents that shed light on the operation of Section 109U of the Income Tax Assessment Act 1936. These documents, Draft Tax Determination TD 2024/D3 and Taxpayer Alert TA 2024/2, clarify key points and warn against certain arrangements. Let's unpack these updates and understand their implications. First, let's establish the basics. What is Section 109U? This section falls under Division 7A of the Income Tax Assessment Act 1936. It's part of Subdivision E, which deals with payments and loans made through interposed entities. Essentially, these provisions are designed to prevent taxpayers from circumventing Division 7A rules by using third-party arrangements. Here's how it works. Section 109U applies when a private company provides a guarantee, resulting in a payment or loan to a target entity. The target entity is typically a shareholder or an associate of the private company. For instance, private company A might guarantee a loan made by a bank to another entity, private company B. Private company B then loans the money to the target entity, who could be a shareholder or associate of both companies. In such cases, Section 109U deems a dividend to have arisen between the private company providing the guarantee and the target entity, provided there is sufficient distributable surplus in the private company. Now let's turn to the key points from the new documents. TD 2024/D3 addresses a critical question. Does Section 109U only apply when the guarantee is given to another private company? The answer is a resounding no. The ATO makes it clear that the law does not require the entity receiving the guarantee to be a private company. It could be a public company, such as a bank. This clarification dissuades taxpayers from believing that Division 7A can be bypassed if the guarantee is provided to a public company. However, it's important to note that the entity ultimately making the loan to the target entity must be a private company for Section 109U to operate. Let's break down an example from the Taxpayer Alert TA 2024/2. A trading company provides a guarantee to a third-party financier, such as a bank. The bank, in turn, loans money to another company, which is referred to as Lending Co. Lending Co., which has a low or nil distributable surplus, then makes a payment or loan to the shareholder of the trading company. Some people have argued that because the guarantee is given to a public company, being the bank, Section 109U cannot apply. However, the ATO points out that this interpretation is incorrect. Finally, let's discuss the ATO's compliance approach. Appendix 2 of TD 2024/D3 outlines the ATO's focus on high-risk arrangements with artificial or contrived elements. While the ATO acknowledges that guarantees are common in private company groups, they emphasise targeting arrangements that display clear signs of risk. For instance, arrangements involving special purpose companies set up with no distributable surplus, or loans routed through multiple entities to obscure the link between the private company and the target entity. In conclusion, the new guidance from TD 2024/D3 and TA 2024/2 reinforces the importance of understanding and adhering to Division 7A provisions. Guarantees, loans and payments involving private companies must be carefully structured to avoid unintended tax consequences. I mentioned in my top tax changes for 2024 the two ATO documents that give guidance on the ATO's views of Section 99B of the 1936 Tax Act. I will now explain these documents in more detail. Let's start with why Section 99B matters. In our increasingly global society, it's common for Australians to receive payments from overseas trusts. What many don't realise is that these payments can trigger significant tax liabilities under Section 99B unless specific exclusions apply. To help taxpayers and advisors navigate these rules, the Tax Office has released these two key documents, being Practical Compliance Guideline 2024/3 and Tax Determination 2024/9. We'll break these down and explore their implications. Section 99B broadly applies to Australian residents who receive amounts or benefits from trusts and especially non-resident trusts. Here's what you need to know. It covers distributions, loans, gifts, and even the use of trust property. Amounts are included in assessable income unless they qualify for specific exclusions under subsection 99B2. These exclusions include the corpus exclusion, so amounts paid from the capital of the trust, and secondly, non-assessable income, amounts that wouldn't be taxable to a hypothetical Australian resident. While the exclusions sound straightforward, proving them can be challenging. The Practical Compliance Guideline, PCG 2024/3, provides clarity on how the ATO approaches Section 99B compliance. Unfortunately, the news isn't all rosy. Here are some highlights. Taxpayers must provide robust evidence to claim exclusions, and payments from deceased estates or offshore trusts often come under scrutiny. A person receiving payments from an overseas trust needs to prove the distribution is either corpus or wouldn't be taxable under Australian law. Without sufficient documentation, the entire amount may be taxed. A key concept under Section 99B is the hypothetical resident taxpayer test. The test assumes the recipient is an Australian resident, but doesn't allow for concessions like the 50% capital gains tax discount or the small business CGT concessions. Another area in which Section 99B could operate is if trust property is used rent-free by an Australian resident. The Tax Office could assess tax under Section 99B based on the benefit derived. The ATO identifies some low-risk scenarios in PCG 2024/3. Firstly, deceased estates. Where we have payments under $2 million Australian made within 24 months of the date of death, with proper documentation, the Tax Office say that this is a low-risk scenario and they won't apply compliance resources to it. Another situation is where you have a loan or use of trust property on commercial terms. Again, the Tax Office will not apply compliance resources to these kinds of circumstances. However, in these cases, even still, you need proper documentation to avoid scrutiny. Now let's shift to TD 2024/9, which explains how the hypothetical resident taxpayer test applies to trust distributions. So the key points include that pre-CGT assets The distributions from these by a non-resident trust aren't taxable. If it's a post-CGT asset, then the trust must calculate the taxable capital gain based on the cost base and disposal value. This gain is then taxed when distributed to an Australian resident if it has not already been subject to Australian tax. One of the biggest challenges is determining the cost base of offshore trust assets. Beneficiaries need historical records, including acquisition details and improvements. Without these, they're likely to face tax liabilities under Section 99B. Advisors play a critical role in helping clients prepare for these complexities. So, what can accountants and advisors do to help their clients navigate Section 99B? Well, number one, ask questions early. Understand the source and purpose of any overseas payments. Number two, raise awareness. Educate your clients about the risks of Section 99B. 3. Stress documentation. Emphasise the importance of maintaining detailed records. And 4. Seek specialist advice. For complex cases, which often these are, consult a tax specialist who is well versed in Section 99B. In conclusion, Section 99B is a complex and potentially punitive provision in Australian tax law. By staying informed, proactive and diligent about the documentation, taxpayers and advisors can navigate these challenges and minimise unexpected liabilities. Thank you for tuning into this episode of TaxCast. If you enjoyed today's discussion and want to dive deeper into more tax topics, don't forget to subscribe to TaxCast on Spotify or YouTube. If you haven't already, I invite you to explore the benefits of becoming a member of my website by visiting johnjeffriestax.com.au. On the website, you'll find a range of practical, downloadable tax training resources tailored to help small and medium-sized accounting firms navigate the complexities of the Australian tax and superannuation system. For more valuable insights and tips, be sure to check out the John Jeffries Tax channel on YouTube. Once again, that's johnjeffriestax.com.au, your go-to destination for expert tax solutions and support. Thanks for listening, and I'll see you next time.